Hello and welcome to the latest episode of the Algebris Investments podcast. My name is Douglas Branson and I'm very pleased to be joined again by Simon Peters. So 2022 was a year of significant events that were very challenging for investors. We had Russia's invasion of Ukraine, inflation and interest rate hikes that all happened within a relatively short period of time. And now, 2 months into 2023, there's a lot of discussion on whether we will see a hard or soft recession, and there's even talk on the prospect of no landing following a raft of what is now called growthflationary data. So how should investors incorporate this into portfolio positioning? Hi Simon.
Hi Doug, good to be back on the podcast.
Great, so look, I'm going to start with what I think is possibly a relatively tough question. What did the smart investors do last year, and in particular towards the end of the year, so sort of from October onwards, and how were they positioned coming into 2023?
Well, let's first remind ourselves how investors were positioned earlier last year. They broadly had a combination of high quality bonds, quality and growth / tech equities, and cash. But in a high inflation, rising interest rate environment, bonds and equities performed poorly. Now, the war and the energy price shock initially made investors cautious, which meant either keeping their existing portfolios or de-risking. Now, in September, the bond market finally priced in both a recession into credit spreads, but also a more believable, higher terminal rate for interest rates. So with a reset in the bond market, what we started to see from some of the smartest investors was a re-engagement in the bond market from October onwards. Now, the bond market is generally yielding 2 to 5%, which still isn't beating inflation, but at least it is stopping some of the severe underperformance of last year. There are also some real pockets of value where investors can sensibly, and we believe safely, beat inflation. But positioning has only partially changed, and so I would expect there to be a continued set of portfolio changes throughout this year. Now, in equities, prospects look less good, particularly for growth and cyclical companies. We can expect lower earnings from those higher funding costs and from slower economic growth. However, one area that has had a terrible decade is the bank sector. With interest rates rallying and banks being the most positively exposed sector, European banks outperformed the S&P by more than 20% last year, and that is likely to continue for the next several years, in my opinion.
Okay, great, and we'll come back to the point about financials, both on the credit and the equity side, in a few minutes. The sort of million-dollar question at the moment is, what sort of recession do you think we'll have?
Well, the market baked in a deep, lasting recession in Europe. However, what's been increasingly clear is that energy rationing hasn't occurred this winter. Governments have subsidized energy costs and made significant fiscal transfers, and gas prices have now fallen below where they were at the start of the war. Now, what that meant was that in the second half of last year, economists slashed their GDP forecasts for 2023, but they started to stabilize at the back end of last year, and the data is now coming in stronger than expected, and economists are now predicting no recession in Europe in 2023, which is a pretty seismic change. So, slow growth in Europe for sure, but equally hardly a catastrophe. Now, in the US, we see strong current data requiring the Fed to continue to raise interest rates, and so we're expecting a bigger slowdown as the cumulative impact of higher rates bites the economy later in the year. Now, what that means is probably a relatively small technical recession over 2 quarters of negative growth now looks pretty baked in towards the end of this year for the US.
Okay, and then just taking the point you made about central banks, how do you think they'll act over the next 6 months? And I suppose what's the most likely path for the Fed, ECB and the Bank of England?
Well, what the market has got wrong is thinking inflation will quickly and naturally drop to 2%, having hovered around 10% only a few months ago, really. Now, this has led the market to price interest rate cuts as early as the second half of this year. The market is beginning to challenge this narrative as we begin to see growth expectations beat and inflation looking higher and stickier. So central banks are likely to offer 2 paths going forward: higher and higher rates than currently expected, or a combination of higher rates and then leaving them at that level for a significant period of time. Currently in the market, terminal rates are being priced at approximately 3.5% for the ECB, 4.5% for the Bank of England, and 5.5% for the Fed. Now, our view really accords with this latter view, where we expect interest rates to be raised close to the current higher terminal rates and then remain at those levels for a considerable period of time.
Okay, and given your last two answers on recession and how you think central banks will act over the next 6 months, how should investors position portfolios now, and can you outline the opportunity set for risk assets over the next 12 months?
Well, I suppose overall the conclusion of the economy and the marketplace is essentially that inflation and therefore interest rates are likely to be slightly higher than expected. The growth prospects, especially in Europe, are likely to be 0% GDP growth, as in no recession, and a small technical recession in the US in the latter half of this year. So what does that mean now for risk assets? Well, in the bond market, investors can finally make some yield, but it is unlikely to compensate for inflation in most cases. On top of that, central banks will start selling bonds back into the market, the QT, as well as governments having to raise more for the fiscal transfers that are currently being made. As such, the technical supply picture in the bond market looks relatively poor. Now, subordinated financial credit issued by investment-grade issuers currently provides high single-digit yields, beating inflation and almost all other bonds. Yet they're also not part of the QE programs, so you don't even get that technical selling pressure. Yet at the same time, the banks are also one of the few sectors that benefit from higher interest rates and are making their largest profits in more than a decade, whilst all other sectors are seeing downgrades. We see this as a home run. Now, for those with a higher risk tolerance, financial equity that has been shunned for a decade has seen a reversal in fortune with the new monetary cycle. Profits at banks especially are increasing by 50 to 100% as we see interest rates climb. Dividend yields in European banks are currently 6 to 10%, with buybacks on top of that and profits climbing. We could easily see bank stocks up more than 50% from here, which sets them apart from what is likely to happen in the rest of the equity market. However, equities do come with more volatility, so maybe the answer is a combination of financial bonds and financial equities.
Brilliant. All right. Well, look, thank you very much, Simon. And as always, thank you to our subscribers. There's clearly a lot going on in markets and risk assets, with 2023 following a regime-changing 2022. We will continue to offer our insights and commentary via the podcast and on our insights page of the website. And we welcome all feedback and questions. So until next time.
Many thanks.